everyone, and a very good afternoon. You're watching Markets at Noon on ET Now. I'm Mubina Kapasi. Nice recovery being witnessed for the equity markets. A very swift one as well at that. We have climbed very smartly from the low point of the day, and now we are at just about the 15,100 mark. The Sensex as well, 51,256. So yeah, that's roughly where the equity markets are at, more or less flattish in trade today, with support coming in from, well, once again, the realty space as well as some sporadic financial names here and there. But otherwise, telecom today is taking a back seat after contributing smartly to the gains of the last couple of trading sessions. Well, Abakkus, meantime, has launched its EM Opportunity Fund. It's in fact one of the best in the AIF C83 long-only category in terms of absolute returns. The one-year return is 44% on an absolute basis. Interestingly, 60 to 70% of its holding is in mid-caps, while the remaining is in small caps. So we decided to bring on the show the manager of this particular fund, Aman Chowhan. Aman, thank you so much for joining us today on ET Now. Why don't you start by introducing a little bit of this EM Opportunity Fund for us, giving us a primer if you have it. I already told our viewers about how a majority of your holdings is in mid-caps. It's, I suppose, in a way, a deviation of sorts from usually what we see, in more public mutual funds and, large funds where the orientation is usually towards large caps. So, what exactly is the rationale, your strategy?
Sure. Good afternoon, everyone. So this fund that we are discussing is predominantly a mid and a small cap focus funds. We focus in companies anywhere between market cap starting from 1,000 crores up to 10,000 crores. And the prime focus in this fund would be to be diversified. We invest across sectors with a cap of 10% per stock. So that broadly has been the background of this fund. It's more than a one-year-old fund, and as you just mentioned, markets have been kind over the last post-April fall, and that has been one of the key reasons, along with the strong earnings growth this portfolio has seen. As far as the strategy of this fund is concerned, it's a very simple framework that we have devised for this fund. We call it as the 15-15-15 framework. Now, what this 15 framework means is that we look at companies which have at least 15% earnings growth. We all like value, but the fact of the matter is that both local as well as foreign investors invest into India for growth. So we would prefer companies which are growing at least 15% earnings growth over the next 2-3 years. The second 15 criteria is the ROE. Companies should have an ROE at least 15% at the time of investment. This directly or indirectly takes care of most of the issues that we face in the company. It could be liquidity ratio, it could be your debt leverage, it could be your moat, it could be your profitability, margins. Directly or indirectly, most of these ratios will get captured in the ROE. If your ROE is 2x of your cost of capital, then you're running a decent, profitable business. And that is something which is very attractive to invest into. And the third most important point is the P, the value that you pay for a company. A company can be a great company, but we always believe in risk-reward equation. A great company also needs to be a great investment. And that's the reason the price at which you buy this company becomes very important. So what we say is that when the time of investment, this company should also be trading at a P less than 15. Now, imagine a scenario where you have a company which is growing, has a good ROE, and a P of less than 15. And it will classify as a great investment. But practically speaking, it doesn't happen. If the company is great, if the ROE business is great, most of the times the P will be higher than 15. So what we have seen that any two of the three criteria should be met at the time of investing. And the third criteria, which has not been met, should at least be visible over the next 12 to 18 months.
Sir, exactly my point. Sir, exactly my point. Aman, exactly my point that I wanted to ask, that, when you talk about a 15% growth company available at a PE of 15 or less with a 15% ROE or a proven track record, you would not get such companies. So do you wait for markets? Now, assuming that markets are buoyant the way they are, in the current scenario, are you being able to find such companies, or you're just holding on to investments that you have and probably you'll wait for a bad market, and if and when you get it, you would make fresh investments?
There are ample of opportunities even in the current markets. It's not that we don't find companies within this criteria. We actively track close to 300 companies, out of which, as we speak, almost 60 to 70 companies would be meeting this criteria, which is beyond the portfolio. The portfolio itself has 30 companies, and we have another 60, 70 companies which fits the criteria. As markets rise, getting the P is not going to be easy, but then you have to move beyond the obvious names. So if you look at the portfolio of this company, you'll see known companies, but these will not be the popular names. These will not be the market favorites because they all trade at a significant premium to the market average. And that is the space that we don't focus on. So we do primary bottoms-up research and focus on companies which are either not mispriced, not well appreciated by the market, or they have some earnings trigger which we aim to capitalize ahead of the others.
All right. Okay. Aman, we leave it at that. Thank you so much for joining us and just giving us a brief introduction of the EM Opportunity Fund. It's been 1 year and it's done extremely well. So kudos to you on that.